Happy Monday, folks. Welcome to the weekly economic update here at DSA Financial Group. Hope everyone had a fantastic weekend. Mine was pretty good. Got to see an old friend of mine from the Navy. They were here in Colorado for a family reunion. They invited us over for the evening on Friday, so that was fantastic. Thanks, Mark and Gina. It's always great seeing you guys. Love y'all a lot. And hopefully y'all are making it back to St. Louis and Atlanta safely. So anyways, all right. Well, hope, like I said, hope everybody had a good weekend. Astros are kicking butt. They're undefeated since the All-Star break. I hope I don't jinx them too much, but they took care of business on Thursday against the Yankees and then swept the Mariners over the weekend. So very exciting. I don't play for the Astros, although I do wear a lot of their stuff. See right there, Astros. Silver Boot Series, what year was this? Like 2006 or 7, I think. Anyways, all right. So like I said, Astros are kicking butt. They're back. Where are they going today? They're in Oakland for a three-game series, and then they head back home for a series on Thursday. So not a terrible day in the markets. Looks like most things are finishing in the green. Let me refresh this screen before I get into it. But markets were in the red most of the day. The NASDAQ probably was taking the worst of it, and looks like it came back pretty good. It was down about 1%. It looks like it finished at about half of that at this point. So let's go ahead and let me share my screen, and we can jump into how the markets did today. Dow Jones was up 0.28%, closed at 31,990. S&P 500 was up 0.13, closed at 39.66. NASDAQ down 0.43, closed at 11,782. Small caps are up a third. The VIX was up 1.43% today. It's currently sitting at 2336. And for those who have not been watching diligently every day, how I view the VIX, this is my own personal opinion. Other professionals may have other views on this. But anytime the VIX is over 20, and what the VIX is the volatility index based upon the S&P 500. So anytime it's over 20, it's kind of like your red light situation when you're approaching an intersection. You're clear to go, but just be careful. If it's a red light or if it's over 30, I view that as a red light situation. You may want to come to a stop, look both ways, and if there's no traffic coming, proceed on. But that's kind of where we're at. Anytime the VIX spikes over 30, usually that is a signal of some bad stuff due on the horizon. So, all right. Moving on to the other exchanges here in the Americas. Canada was up 0.64. Brazil was up 1.36. Mexico down 0.13. Jumping across the pond, Germany up 0.41. Germany down 0.33, the UK up 0.41, France up 0.33, Euro Stoxx was up 0.21, Netherlands was up 0.28, Spain up 0.42, Italy up 0.8, Switzerland up 0.3, and Portugal up 1.1%. Wow. Head a little further east, the Russian exchanges, the MOEX was up 1.54, while the RTSI was down 0.52. Heading further east over to the Asian markets, Japan finished down 0.77, Australia down, or basically flat. It was down 0.02%. New Zealand down 0.7. Moving over to China, the Shanghai down 0.6. SCSE component down 0.83. China A50 down 0.35. The DJ Shanghai down 0.67. And the Hang Seng down 0.22. And the Taiwan weighted looks like it came in flat. It down 0.09% today. So it looks like the Asian markets were in the red, all of them less than 1%. Across the European markets, mostly up. Some of them, a couple of them here were up 1%, but most of them about 0.5% or less. And then, like I said, here in the U.S., I'd call it a fairly flat day, all things considered, in the red most of the day, and then rebounded at the close. All right. So that's how the markets did today. Let's go ahead and read through this week's weekly economic update and see what news is on the horizon. The week on Wall Street, stocks rallied last week as investor spirits lifted thanks to a better than expected start to the second quarter earnings season. The Dow Jones Industrial Average gained 1.95%, while the SP 500 added 2.55%. NASDAQ Composite jumped 3.33%, and internationals were up 3.54%. Earnings propel stocks. Earnings season kicked off last week with major banks reporting second quarter results. While the results were mixed, they appeared to indicate that consumers and businesses remain reasonably healthy, a perspective that helped erase some negative sentiment overhanging the market. As the week progressed, stocks gained momentum as earnings results poured in from different sectors of the economy, showing that businesses were navigating higher inflation and slower growth better than investors feared. Technology and other gloomier sectors were among the market's best performers for the week. A few disappointing corporate reports and a weak economic report sent stocks lower to close out a solid week. Cracks in the foundation. Data released last week indicated more trouble in the housing market. The latest monthly home builder sentiment survey showed the single largest monthly drop in the 37-year history, except for April of 2020. The sentiment report preceded a drop in June housing starts and issued building permits. Housing starts declined for the second month, falling 2%, and surprising economists who had expected an increase. I don't know why. Rates have been going up, and like we've talked about, till I've been red in the face. Is that the higher interest rates go, you're going to price out a lot of people who, at the time when rates were or the Fed fund rate was at zero, they could get a loan at 2.5%, 3%, and you could get a lot more house for that same interest rate versus, rates are now up around 5 to 6% for your average 30-year mortgage. And so that's just going to raise your payment up, which, if that's how you're qualifying, is based upon payment or your debt to income ratio, you're going to price a lot of people out of the bottom end. Housing weakness made itself known through a 5.4 month-over-month decline in June's existing home sales, representing the slowest pace since June of 2020. Increasing prices and higher mortgage rates demonstrated drags on buyer demand. All right, economic data coming out this week. Tomorrow on Tuesday, we have new home sales. Wednesday, we have the FOMC announcement and durable goods orders. And Thursday, we have GDP and jobless claims. We've got a ton of businesses reporting earnings this week. On Tuesday, we have Microsoft, GE, Visa, Google, General Motors, Coke, McDonald's, good. Or I'm Lovett, I'm sorry. Archer Daniels, 3M, Texas Instruments, UPS, and Kimberly-Clark. Wednesday, we have Boeing, Ford, Qualcomm, Bristol-Myers, Lam Research Corporation, Shopify, ServiceNow, General Dynamics, and Norfolk Southern. Thursday, we have Apple, Intel, MasterCard, Pfizer, Merck, the Southern Company, Northrop Grumman Corporation, and Southwest Airlines. And Friday rounds out the week with AbbVie, ExxonMobil, Chevron, Procter & Gamble, and Colgate-Palmolive. All right, well, that's everything as far as the weekly update. I do have 2 white papers going out to clients in their email this week, or will be going out in a few minutes once I finish this up. This first one is, what happens when there are no beneficiaries? Where do those accounts and policies end up? Some accounts have no designated beneficiary. Rarely, the same thing occurs with insurance policies. This is usually an oversight. In exceptional circumstances, it's a choice. What happens to these accounts and policies when the original owner dies? The investment or insurance firm gets the first chance to determine what happens. On many retirement plans, for example, the spouse is often the default beneficiary, even if not named on a beneficiary form. If the deceased has no spouse, then the plan assets may just become part of that person's estate. Brokerage accounts without a designated beneficiaries are also poised to become part of the estate of the decedent. The next stop for those assets could be probate. The state may end up deciding where those assets go when beneficiary forms are blank. If the deceased failed to name account or policy beneficiaries but had a valid will or other valid estate documents, this will influence the path from here, but it may not exempt the assets from probate court. If no legally valid estate documents exist, then the deceased party dies intestate, and the state determines the destiny for the assets. Most states go by the same ladder of potential inheritors, surviving spouse at the top, then kids, then grandkids, then parents, grandparents, siblings, nephews, and nieces. If absolutely no legitimate heir can be found, then assets become property of the decedent's state of residence. What about life insurance policies? A life insurance policy usually has at least two levels of designated beneficiaries, and it's rare when a policyholder outlives them, or even rarer when a policy has none. In such a circumstance, then the proceeds of the life insurance policy become part of the estate of the policyholder upon the policyholder's death. Several factors will affect the cost availability of life insurance, including age, health, and type and amount of insurance purchased. Life insurance policies have expenses, including mortgage, mortality, and other charges. If a policy is surrendered prematurely, the policyholder also may pay surrender charges and have income tax implications. You should consider determining whether you are insurable before implementing a strategy involving life insurance. Any guarantees associated with a policy are dependent on the ability of the issuing insurance company to continue making claim payments. Those allergies are hell this time of year. What happens? What if a person simply lacks possible heirs or sees no worthy heirs? Occasionally this happens. Some people remain single for life, and others are estranged from relatives or heirs who would otherwise be beneficiaries. A person in this situation has a choice. Charity, perhaps a charitable or nonprofit organization, deserves the assets. Perhaps a college or university would be a worthwhile destination for them. Choices exist, and those who are single can explore them as they consider their estate. All good stuff there. So, don't leave your accounts or policies without beneficiaries. That's probably the best advice to give right there. All right, next up, required minimum distributions 101, understanding mandatory retirement account withdrawals. If you're approaching your 70s, get ready for required minimum distributions. You may soon have to take RMDs, as they're called, from one or more of your retirement accounts. You can now take some RMDs a bit later in life, which is good. Recent rule changes give your invested savings a little more time to potentially grow in your retirement savings vehicles before the first required drawdown. What account types require RMDs? Any retirement plan sponsored by an employer, plus traditional individual retirement accounts, or IRAs, and IRA-based retirement plans, such as simple IRAs and simplified employee pension plans, or SEPs, as we call them. Original owners of Roth IRAs do not have to take RMDs. You can take your initial RMD from a retirement plan by December 31st of the calendar year in which you turn 72. You actually have the choice of taking your first annual RMD as late as April 1st of the following year, i.e. the year in which you will turn 73. But you'll have to take your second RMD by December 31st of that same year. So if you wait 16 months to take your first RMD, you'll end up taking both your first and second RMD from the account in the same year. And since each RMD represents taxable income, that could lead to higher than anticipated tax bill for that year. So any money that comes out of IRAs, except for Roths, is because it's never been taxed. When you do receive those, take a distribution, if you already had, say, $40,000 in income passively from somewhere else, and you took $20,000 out of, IRAs or 401ks, you just added $20,000 to your income, so now your taxable income is $60,000 in that scenario. Where was I? How are RMDs calculated? The Internal Revenue Service, or vampires as I like to call them, provides calculation formulas in Publication 590-B. Commonly, you calculate your RMD by dividing the balance of your retirement account on December 31st of the previous year by a life expectancy factor, a number you take from tables published within Publication 590-B. If you have multiple retirement accounts, each one will require an annual RMD calculation. If you own multiple traditional IRAs, you have the choice to calculate RMDs for each of those IRAs and take the combined RMDs from all three IRAs from just one of those IRAs. You have the same choice if you have multiple 403(b) plan accounts. What do you need to do to avoid penalties from RMDs? The most important thing to do is to take them by the annual December 31st deadline. The second most important thing to do is withdraw the right amount. If you take an RMD after the December 31st deadline or withdraw less than you should, a penalty may apply. The IRS may levy as much as a 50% tax on the amount not withdrawn. Boy, those are nice guys. The good news is some investment firms will update you on your upcoming RMD well in advance of annual deadlines, and your RMDs may even be calculated for you. This is not a given, however, and even when you receive such information, you must act on it because it takes time to authorize and execute the RMD. Lastly, take a look at how RMD income may affect your taxes. There are ways to manage the tax impacts of RMDs, and you can explore those choices with a financial or tax professional. I know a guy, this guy. All right, so that's some more good stuff. So, I mean, that's something that, usually in the first quarter of each year, I go back and run all the calculations for all my older clients just to make sure that we're taking out enough throughout the year. And then what hasn't been withdrawn, we take care of usually in the last, month or two of the year. All righty, well, let's go ahead and read through today's market recap. S&P 500 slips ahead of big tech earnings and a Fed meeting. The S&P 500 fell Monday as investors, well, actually, we know it actually finished in the green, but when they wrote this, it was in the red. Fell Monday as investors looked ahead to quarterly earnings from big tech and the Federal Reserve meeting set to kick off later this week. Tech stumbled ahead of quarterly results from big tech. Microsoft Corporation and Alphabet are set to report earnings on Tuesday, with reports from Meta, Amazon, and Apple due later in the week. The rally in tech since mid-June has coincided with a slip in Treasury yields, making it more attractive to own higher value growth sectors of the market as investors price in a less hawkish Federal Reserve on signs that inflation is moderating as economic growth softens. Again, I don't know where they're seeing this moderating in inflation. Yeah, gas prices are down 50 cents or whatever from their peak, but I mean, they're still several dollars higher than what they were a year and a half ago. So I really don't see it. And I mean, maybe when the next consumer price index print comes out in a few weeks, hey, if it pulls back, I'll say, hey, I was wrong. But until I actually see data that confirms it, I'm not just going to go off what a bunch of journalists and talking heads have to say. Quote, the tightening in financial conditions to date is already large enough and the growth trajectory is already low enough that speeding up would be unnecessarily risky, end quote, Goldman Sachs said in a recent note forecasting the Fed to hike rates by 0.75 point on Wednesday. Consumer discretionary stocks were also a drag on the broader market, paced by weakness in retailers and home builders. Energy rose by more than 3%, supported by a jump in oil prices amid a weaker dollar and ongoing concerns about supply fears. Natural gas prices, meanwhile, jumped sharply after Russia's Gazprom said it would cut Europe's gas flow via Nord Stream to 20% because of maintenance issues. Yeah, I would probably guess this is more of just Russia being a big old dick to the folks in Europe for the embargoes that they've had on Russian oil. So it's just Russia giving them the middle finger. I mean, they're still selling oil to other places. If a portion of the world says, hey, we're not going to buy your oil because of what's going on in Ukraine, that's fine. They'll sell it to China, India. They may have to sell for a little bit less than the going rate, but if anything, that'll actually help bring prices down. All right. APA, Marathon Oil, and Diamondback Energy were among the biggest gainers, with the latter up more than 6%. Financials, meanwhile, also played a role in the broader market climb, powered by a rally at regional banks as Treasury yields inched higher. SVB Financial Group climbed more than 8% after Evercore upgraded its rating on the stock to outperform from in line, citing an attractive entry point. On the earnings front, Newmont Gold Corp sunk 14% after the mining company reported quarterly profit that fell short of Wall Street estimates. Crypto-related stocks were also on the back foot as Bitcoin fell 4%. MicroStrategy, Riot Blockchain, and Coinbase Global were down about 6% for the day. All right. So kind of a mixed day. Again, I look at things, it's kind of just flat. We're all waiting to see what's going to happen with the Federal Reserve later this week. My expectation is they'll probably stick with the 0.75 basis or the 75 basis points. And, they'll probably stick with that just because they've telegraphed it for so long. Personally, I'd like to see them raise rates much faster than what they're doing. These little piranha nibbles that are, nibbling away at our back end. I just don't see it, really being effective. But hey, these are supposedly the smart people running things who got us into this situation. So maybe they have a real plan that's going to get us out. I doubt it. All right, next article here has to do with housing. U.S. housing cooled down is recession red flag for markets. With the Federal Reserve set to jack up interest rates again. I mean, it's just the bias that you read in so much of the media is just, it's ridiculous. It just grinds my gears. The interest rates again this week. Wall Street is on alert for signs of recession, and recent housing data suggests the sector may be a harbinger of a cooling economy or a canary in the coal mine. For those who watch Westworld, pretty good episode last night. Wasn't as good as episode 4, but answered a lot of questions if you're a Westworld fan. Give me a call if you want to talk about it. Homebuilder stocks, sales, and mortgage data showed that the previously booming housing market is falling back to earth amid a broader economic cooldown. Surging mortgage rates, exacerbated by Fed hikes this year, have begun to reverse a demand-supply imbalance, the result of suburban stampede prompted by COVID-19 lockdowns. The ensuing drop in inventories, along with the scarcity of lots, materials, and construction labor, has launched home prices into orbit. Yep, they're pretty high. Combined with the highest home loan rates in a generation, and affordability has evaporated along with demand. On Tuesday, 2 additional housing indicators are expected. Its first is the S&P Case-Shiller's 20-city composite, which is expected to show year-on-year home prices cooled in May to a still blistering 20.8%. Also on Tuesday's docket, the Commerce Department's new home sales number is expected to have fallen by 4.6% last month. Annual home price growth has been in double digits since December of 2020, just before demand for loans to buy homes started falling. Last week, the National Association of Home Builders Housing Market Index builder sentiment plunged to its lowest level since May of 2020. The seasonally adjusted annualized rate of new home sales compared with NHAB's gauge of prospective homebuyer traffic shows the market is in its second month of pessimistic territory in July. Among the challenges home builders face are production bottlenecks, rising home building costs, and high inflation, according to the NAHB. Those sentiments are also echoed in June housing starts data from the Commerce Department, which fell 2% to a 9-month low. The National Association of Realtors showed sales of pre-owned U.S. homes slid 5.4% from May to June and plunged 14.2% from a year ago. Just since January, existing home sales have slid 21.1% on a downward slope that coincides with the average 30-year fixed contract rate climbing 249 basis points to 5.82%. This is the highest level since December of 2008, according to the Mortgage Bankers Association, which also reports overall mortgage demand has touched a 22-year low. With this cooling demand, the number of months supply of pre-owned homes on the market has recovered to 2.9. The most plentiful inventory print since July of 2020. While data looks backwards, the stock market looks forward, reflecting where investors believe the sector will be in 6 months to a year. The Philadelphia SE Housing Index is still outperforming the broader S&P 500 since the nadir of the COVID-19 sell-off on March 23rd, 2020. But that relationship reversed around the time mortgage rates started on an uphill trek. So far this year, the HGX and the S&P 1500 Home Building Index have consistently underperformed the Bellwether Index. The Federal Reserve's 2-day policy meeting convenes on Tuesday and is expected to culminate in the second straight 75 basis point rate hike. The central bank has pledged to rein in inflation while also trying to avoid tipping the economy into recession. Yeah, they can keep saying they're not going to do it, but I think they will. But what does that mean for housing stocks going forward? Quote, the housing market and home building are early cyclical movers, which were in a late cycle pre-recession, said Ken Leon, director of equity research at CFRA in Washington. Quote, the trends are going to continue to be challenging for the housing market, end quote. And again, I mean, anyone who's in the home, if you're a realtor or you're a mortgage banker, I mean, you had to see the writing on the wall that, all of this demand, which was sparked by people wanting to, move out to a more suburban or rural environment. And there just wasn't enough homes to go around that, that's why prices, spiked like they did. And with interest rates, being so low, it just made it very attractive for buyers to just gobble up as much much of those properties as possible. Plus, then you hear the scuttlebutt about BlackRock and Blackstone and all these big old hedge funds out there, gobbling up properties, buying things sight unseen. Whether or not that actually happens long term, I don't know. I'm skeptical. I mean, what happens if, let's say these big hedge funds and investment bankers, buy up an entire city? Well, if everyone leaves, now they're stuck with all these houses that no one wants. So, that's a very dangerous thing. It's kind of like the person who, they buy up homes, all over in one particular area, and say, the plant or the industry in that area dries up. Well, now you've got 50 houses that no one, if there's no one wanting to live in that area to work in that, community, now you just got 50 houses that nobody wants to live in. So, spread your wealth around, people. All right. Last article I got here has to do with what the government is doing as far as recession. They're trying to change the definitions. If you go to like Investopedia or I guess Webster's, the definition of recession is 2 consecutive quarters of negative GDP. I mean, I've been in this business for over 16 years now, and that's always been the standard definition. Similar to if the stock market pulls back, 10%, that's a correction. If it's more than 20%, that's a bear market. I mean, again, you wouldn't change these definitions mid situation, just because you have to leave things somewhat static so what data you're looking at. So, excuse me. All right, recession. They will tell us that it's misinformation. It comes from Zero Hedge. Last week, this space speculated that the next recession may never be called what it is. Government agencies rely entirely on the National Bureau of Economic Research to call it either way. In October of 2020, the NBER posted a clarification that it does not accept the textbook definition of 2 consecutive quarters of output decline, but instead deploys a more holistic view. What do they got, like crystals? Or are they sitting around, doing a seance? I mean, come on. As an example of such a deployment, NBER lists March through April 2020 as a recession due to the severity of the downturn and the high levels of unemployment. It's hard to disagree with that judgment, though it was one of the strangest recessions in history. It was entirely forced by lockdowns, so natural market forces did not cause it. It was because basically the government shut everything down. So I wouldn't call that a recession personally. NBER is in this case, was using a stricter definition than the textbook. Now the White House is running with this loser approach, preparing a propaganda push later this week if the second quarter numbers return a negative return. You will see the spokesperson will absolutely deny there is a recession, saying there is one will suddenly be seen as a political statement. Affirming that all is well will be the, quote, information, whereas saying otherwise will become misinformation. As for NBER, it is a cautious organization and will likely wait several more quarters before weighing in at all. Here's what the White House statement to prepare the way, quote, recession probabilities are never zero, but trends in the data through the first half of the year used to determine a recession are not indicating a downturn, end quote. In more detail, was a recession. While some maintain that 2 consecutive quarters of falling real GDP constitute a recession, that is neither the official definition nor the way economists evaluate the state of the business cycle. Instead, both official determinations of recession and economists' assessment of economic activity are based on a holistic look at the data, including the labor market, consumer and business spending, industrial production, and incomes. Based on these data, it is unlikely that the decline in GDP in the first quarter of this year, even if followed by another GDP decline in the second quarter, indicates a recession, end quote. Again, they're just moving the deck chairs around on the Titanic and redefining things that have been pretty standard for quite a while. I mean, again, a decade and a half for me, that's always been the way it has been defined. What are the factors that the White House pushes to mitigate against the declaration? No inflation. Never. Instead, the statement emphasizes that industrial production, employment, and real spending have grown this year, end quote. Note the careful wording, this year, does not mean right now. The subject of employment we've written about extensively. The labor shortage is spooky and accounts for the whole of the seemingly low numbers in technical unemployment. The 2020 lockdowns introduced labor market chaos that is nowhere near being solved and likely won't be until there are major structural reforms and that deregulate markets and curb the subsidies for the idle. As for real spending, Americans are depleting savings at a massive rate and borrowing in ways that reverse two-year trends. To see this as a good thing would require full immersion in 90-year-old Keynesian hydraulics. Yeah, the Keynesians, they love to just print money, and they don't ever see the wants and needs of the consumer. They don't take that into account. Everything is just this sterile, Excel spreadsheet. And if you change a couple things and makes the numbers look good, but you take human wants and desires, that it has no play in there. The reality is more clearly discerned by the institution that this is not a good trend. It is why most Americans today feel like they are paddling upstream and still falling back. It feels like economic regression, and the data show that it is. It is truly hard to believe that the White House wants to invoke these trends in defense of the idea that a recession is not already here. That leaves industrial production as a trend as a trend celebrated by the White House. Let's have a look. The total index is precisely where it was in 2018, which in turn reflects its level of 2008, the year that ended a full century of even higher growth. The consumer goods index has not recovered its 2008 highs, nor has manufacturing goods. In all three categories, the latest from June of 2022 shows declines. This is why the press release wants to talk about this year rather than last month. It's hard to imagine that this is what the White House considers brag-worthy. Indeed, the economic health of the American economy isn't much different from the job approval numbers of Biden himself, which are now drifting towards the low 30s, the lows of 30%. It doesn't matter how many op-eds appear in the New York Times to say otherwise. People know the truth because they see it in their bank accounts and feel it in their lost hopes and dreams for a bright future. Well, folks, don't feel too bad. Things will be great in the end, but I think we're just going to go through a rough patch. Maybe the federal government collapses. Let's hope. The dollar will probably collapse. I mean, all the things they're doing right now are, in my opinion, are leading us towards economic destruction. But once we come out the other side, I think we'll be all right. So, having assets that will hold their value through these situations is probably your best bet. I suggest working with a financial advisor, financial planner. They can help you pick out the right things and hopefully navigate the ice field that the Titanic is heading into. Let's just hope that those at the helm actually can steer us around the icebergs as opposed to doing bumper cars like they've been doing the last 2 years. And we can actually pull into New York safely. But again, might want to get your life jacket on and stand close to the lifeboats because the people in charge right now are just village idiots, and I don't have a lot of confidence in them. So, anyways. But if you want to get your crap together, feel free to go to dsafinancialgroup.com. You can read through everything that I do for folks, book a meeting, drop me a phone call or an email. I'm always here for people who want help. And anyways, all right. Well, hope everyone has a fantastic Monday evening, and I'll be back tomorrow with the Liberty Call. So I hope everyone has a great night and go watch some Astros baseball. Bye.